I talk to lots of folks who are considering starting their own firm. I would tell them is, think of it as, when I say it's affectionately the wild, wild west, I say it in a good way. You have all these options. But guess what? Now you have to have the resource allocation to implement all these options.
Welcome to this episode of Trends with Benefits. I am Ed Lopez, and I am your host today. And I am speaking with Craig Robson. He is founding principal and managing director at Regent Peak Wealth Advisors. And we're going to be talking about alternatives and private investments. Craig, welcome to the show.
Thanks, Ed. Good to be with you.
Yeah, thanks for joining and covering this topic. I think it's a relatively hot topic over the last year or so. And really just today, another little headline came across related to all of this, which was a platform, Ardian, raises $30 billion in a secondaries fund. That's just the headline I saw. I haven't really dug into it, but does that ring true to you, to anything that you're doing that we're going to end up talking about today?
Well, I did not see the article, so I'll go take a look at it afterwards, but maybe they could be a new relationship for Regent Peak after you share those numbers. Wow.
Yeah, I mean, I think it was pointing to this idea of the need and growth in the secondaries market to provide liquidity for private equity investors. And I thought it was just kind of an interesting trend that I was going to ask you about later on as well. One of the things that I like to do with our guests, probably usually towards the end, is kind of go over background and your business and give you an opportunity to do that. But I'm going to do that up front because I think I would love to hear about your business in particular and how you look at alternatives. And I know it's a big part of your practice and perhaps why it is. And let's start there, and then we can kind of get into alternatives and private investments that you might be looking at.
That'd be great. So maybe high level just for your audience. So Regent Peak Wealth Advisors is a registered independent advisory firm who intentionally serves what we consider wealth creators. And Ed, I think of those in really four buckets or categories. First would be your corporate executives, CFOs, CEOs, chief technology officers. They create lots of wealth and they have lots of needs, and we're there to help them and serve them. The second would be business owners. If you think of a business owner, Ed, typically the majority of their net worth is tied up in the four walls of their business, and they need help pre-liquidity event and post-liquidity event. So those are fantastic relationships for us to advise. The third, Ed, would be what I consider as multifamily generational wealth. So you have a matriarch, patriarch who's done a fantastic job of growing their wealth, working extremely hard, saving, and they have these great dreams and aspirations of passing along their wealth to future generations. Who doesn't? We advise them, Ed, that many times the future generations don't do as good a job as mom and dad. And because they didn't have the tools, the resources, the advice, they didn't have maybe the same desire. And so we try to help those relationships in terms of coaching them up and elevating them so that wealth is, when it's received, they do a fantastic job like mom and dad and can pass it on for future generations. And then our last category, which is the smallest subset, Ed, within our practice, would be divorcees. And most people, Ed, don't think of divorcees as a wealth creator. But typically, the relationships that are introduced to us are unfortunately going through divorce, and they need representation. They need advice and counsel. Typically, the other spouse maybe manage the family finances, and there's a huge learning curve. And all of a sudden, a large amount of money is, in essence, transferred into their account in their name, and they don't know what to do with it, right? So high level, that's who we are, and that's the families that we serve. And then we can certainly dig into why we think alternatives and private investments are an important part of high net worth and ultra high net worth families that we serve. I'll stop there and see if you have any questions on that.
No, that's great. Thanks for that overview. And as you mentioned, divorcees, we had an episode on widowers and widows, and I perhaps I could fall into that bucket as well, and perhaps as hate to say it, as a trend going forward with an aging baby boomer class, that you might have more of those in your client list.
Agreed.
With the idea that we're going to talk about alternatives, maybe let's kind of set the stage. Our audience is some individual investors, other financial advisors, but alternatives covers the broad. In your mind, what are we talking about? What are alternatives to you, and what are you looking at?
You bet, Ed. So we think of alternatives as it's a separate asset class. And maybe for your audience, just to kind of simplify things, as an advisor, when we talk to our relationships, we want them to have a multi-asset class approach. So public equities, which most people understand, fixed income or bonds, right, would be the second. Cash or cash alternatives would be the third. And the fourth would be this less popular, though there's certainly more interest, and we'll talk about today, alternative investments. Now, candidly, I don't love the name, but I'll acknowledge the industry is kind of locked into that name, so I don't think I'm going to be able to change that. So when we think of alternative investments, let's give you some examples. So the examples could be currencies. The examples could be commodities, gold, silver, copper. It could be digital assets, right? Bitcoin, Ethereum. We could certainly spend some time on that today. It could be private equity. It could be venture capital. It could be private real estate. It could be private credit. So all of those are subsets of this asset class that the industry calls alternatives. And then the reason is, why is alternatives so important? Why does Regent Peak think our families and relationships that own them? Historically, Ed, this asset class has what we'll say is different return streams, different volatility characteristics than those other three asset classes I just referenced a few minutes ago. The industry likes to use these big phrases, non-correlation, but just to simplify it for your audience, in like a pistons of an engine analogy, right? Typically, when one asset class is up, others are not up as much, or may even be down, right? It's rare that all the asset classes are up at the same time. Those are wonderful years, by the way, but those don't happen very often, right? So the job is to make sure that you've got the right portfolio construct of these different asset classes. Let's use 2022 as an example. Public equities were down about 18%. Public bonds are down about 13%. So if somebody had a 60-40 allocation of those two, you're scratching your head saying, wait, I was diversified. I had two different asset classes. I was told they react differently, and they did it. Well, guess what? Private investments for our relationships were all positive in 2022. So it worked as a nice shock absorber, or that pistons of the engine, whatever analogy works for you and your audience. So that's why we think it's really important for our relationships to own, because ideally what you're trying to do is you're trying to smooth out the roller coaster ride for your relationships so that they continue to grow their assets in a meaningful way and fund those goals that they outlined for us are super important.
Each opportunity or each type of investment within the alternatives bucket might be different. It might be looked at in a different way, but you talked about it in terms of differentiated performance or a lower correlation to some of the other asset classes. Is that the primary goal? Is there ever a time where the primary goal is outright alpha or growth?
Oh, sure. I mean, some of these investments historically do significantly better than other asset classes. Yet with every investment, I always say buyer beware. Right? You have to understand what you own and why you own it. And what are the timeframes? What are the liquidity parameters? What are the volatility characteristics? What are the expected return streams? And just because you have an expected return stream doesn't mean that that manager, that strategy will hit on that or execute on that. So, but no doubt, I mean, part of these could be is, historically private equity does incredibly well. Yet we've seen the last couple of years where private equity has not done nearly as well as its historical numbers or its public equity markets. Does that mean that you don't do it anymore? No. You understand why maybe the muted returns are for the last couple of years. It helps you to kind of understand and educate your relationships and make, important decisions on a go-forward basis.
And, it's been a fairly hot market lately. I feel like every other headline's about private credit or private equity, private something, another private fund, or new partnerships among asset managers and private platforms and things of that sort. How would you characterize the environment that we're in today for private investments, just broadly? Is it good? Is it neutral? Is it frothy?
I'll go back to that subset conversation. So if we're talking digital assets, Bitcoin and Ethereum, it's certainly frothy, right? That doesn't mean it can't go higher, and it may. Nobody knows for certain, right? I would say private credit has certainly done really well over the past 5 years. And I mean, primarily due to function of where interest rates have gone, right? And we could spend some time on that later in the podcast if you'd like. So private credit, I wouldn't call it a saturated trade, but I would certainly say there's been a lot of momentum and a lot of interest, and you just want to make sure that you don't over allocate towards that one. Venture capital, as its name suggests, is, we hear it all the time, like high risk, high returns. We think that's an important component if clients can handle the lack of liquidity and understand kind of the timeframes associated with those expected returns. So, back to kind of your comment, and private equity, as I referenced a little earlier, has done well, but not as well as we've seen maybe 5 years earlier. I think that's a function, again, of the fact that you have so many companies that are looking for exits or excited to exit, and the higher interest rate environment is causing many companies to take a step back and say, the costs associated with acquiring another company are pretty expensive right now. And so there's kind of a pause factor. So you're not seeing as many exits or liquidity events in the private equity space. So Again, that's why I think private equity is just not done as well in the last couple of years, but we still like it a lot. So the answer to your question, I think that space is still doing very well. Components within it are doing better. And back to my pistons of an engine, that's pretty typical of what we see.
From a client standpoint, I know you tend to deal with, it sounds like mostly high net worth individuals, but just generally for those listening, who are alternatives right for? Let's start there, and then we can talk a little bit about how you approach that, the sizing of an allocation in a portfolio.
Yeah, happy to, Ed. So who are alternatives right for? If the regulators were on the call today, the SEC and FINRA, they would say that, and these are general phrases here, that you're looking at more sophisticated investors. I don't typically love that terminology. That's what they typically like to use. But in essence, they're looking for families or relationships that have a higher net worth and a higher income, right? And the reason they do that, they're casting a wide web, is because they feel that that's a good proxy on investors that can handle lack of liquidity, longer timeframes, K1 tax returns potentially, the more opaqueness of these type of investors. So maybe said differently, Ed, my 17-year-old who's very interested in digital assets, because that's the hot thing right now, is not a good candidate for owning private equity, to make an extreme example, right? On the flip side, there's a lot of investors and a lot of relationships that are good candidates and have never had the opportunity, have never had somebody speak to them. They've been educated on it. And so, yeah, I would tell you, most of the new relationships that we onboard, Ed, have zero exposure to the alternative investment asset class, when we talk to them. And that's a differentiator. We don't do it for differentiation alone. We do it because it's the right thing from an overall portfolio construct. So maybe to come back to your initial question, I think it's fantastic asset class from that non-correlative kind of mitigating the volatility for any relationship that certainly fits within the regulatory requirements. And then there's other asset classes or subsets such as gold and silver. You don't have to have high net worth minimums for owning that, or even the digital asset space. I always go back to buyer beware and know what you own and why you own it.
Are you finding that your clients and new clients that come to you are asking for private investments or some of these alternatives, or are you finding that you are introducing them to this opportunity generally?
It's definitely the latter, Ed. And typically how a discovery conversation call would go with a new relationship is, after we get through pleasantries and getting to know each other and talking about kind of their needs, when we get into the investment solutions aspect of the conversation, most relationships already have exposure to public equity. So I'm not going to share with them anything that's earth-shattering that they haven't done already. There's some unique things that we talk about, but generally they got that covered. The minute we start talking about private investments, it's like the antennas go up and they're like, tell me more. I don't have any exposure to that. One of the reasons I'm talking to you is, the introduction, the mutual contact we have, reference that your firm diligences these for us. And I'm very interested in learning more about this. So I think the higher net worth family is much more open and much more eager, but the reality is they're not receiving or having access to those in the previous advisory relationships that they were working with.
And today, where are you guys seeing opportunities in the private space? Is it, you already talked a little bit about private equity, maybe not as promising, maybe that's not the right word, but in the grand scheme of things, how do you identify what opportunities you bring to what client? And maybe it's very client specific. But if you would start kind of generally, are you more interested in looking at private credit these days, for instance, or certain types of deals in private equity?
Yeah, happy to. So first, I want to be really clear for you and your audience. We're big advocates of private equity. I would just say the last 2 years in particular, the returns have not been as frothy, maybe with the phrase used earlier, as what we kind of expected or come to see in the previous years. And really, I think that's a function of interest rates, as I mentioned. I think those returns will come. They're just, some of the private equity strategies, right, only made 16 or 17%. Nobody should be upset about those, right? But when the public markets have been up, the S&P has been up 6% last year and 23% the previous year. I mean, public markets have done better, and you just don't compare those two. But guess what? Most relationships we use the S&P as the proxy. So that's my comment there. So going back to when we build out a portfolio construct, we don't try to recreate the wheel. Once we understand your hypothetical risk profile, you're going to have the same percentage allocation of private equity, private credit, right? Private real estate, digital assets, potentially venture. So we have kind of what I would say is a risk profile that our investment committee sets for each of those profiles. And then once we understand your profile, then we'll fill you or fit you into that, obviously with lots of education and making sure you understand the uniqueness of them. The one-offs are really more like on some of the venture strategies, which are less what I would say evergreen or perpetual. And so we made diligence a venture capital strategy. In fact, we did 2 last year, which were very artificial intelligence focused. And so those, when those allotments are filled, that's it. There's no more to invest in. So those are more the unique scenarios, I would say.
Any hard lessons learned over the years in doing this, and certain things that you now look for that you didn't when you first started out?
I think the one comment that kind of comes to me, and I won't name the manager, of course, you can diligence a strategy all day, and then you either will get comfortable with it or you won't. It's the monitoring that is equally, if not more important. So we had a strategy back in 2008, 9, 10, who had some really fantastic risk-adjusted private equity returns. And then they started to shift and they started to go away from what they told us they would be doing. And, you know, the signs for me, Ed, was that I saw them too much on CNBC. I saw them too much on talking shows. I was like, well, who's managing the day-to-day? I started to scratch my head, like, I hope somebody's minding the storefront. And so I think the lessons learned is we could diligence something, sign off on it. That doesn't mean that, you know, somebody gets intellectually lazy, and that happens from time to time in their industry. So, you know, some of these folks make lots of money and they're more interested in buying baseball teams than maybe managing their fund or their venture capital strategy. So long story short, the lessons learned is that monitoring is just as important as the initial diligence to approve.
Now, what do you think has driven the interest in privates generally? And I'm thinking back about some stats I've seen about global IPO markets, for instance, and hearing that companies are staying private longer, and there's a dearth of new IPOs in the market. Do you think that's a major factor in the growth of the space, and perhaps a factor in your own interest in this area for clients as well?
Yeah, so a couple things to maybe like unpack there. So let's go to your IPO comment. Nobody knows for certain if IPOs will become a thing again. What I would tell you is that there's a trend which is undeniable, which is that there are less public companies today than there were when I started back in the early 90s. In the early 90s, when I started in the industry, there was roughly 8,000 companies that traded on the exchanges here in the U.S. There's half that number in 2019. So you take a step back and you think, well, why is that? There's lots of reasons. I think some that are pretty obvious would be A, it's very expensive nowadays to be a public company. The regulators require more and more of you in terms of reporting requirements. That's not necessarily a bad thing. It's just a fact you have to own and acknowledge if you're going to choose to go public. Your cost centers for satisfying the regulatory environment went up significantly. I mean, the second could be is the pressure on these C-suite executives, I know because we work with them, to hit their numbers every quarter is massive. And so I don't recall being that high pressure oriented in 1994 when I started. There's still pressure, don't get me wrong, but it's just the stakes have gotten higher and higher. You miss an earnings call, you cut a dividend, stock's going to get whacked, your job's going to be in jeopardy. So, you know, if you're private, obviously you're going to report your numbers to your board and your team, but you're not dealing with the public markets in that sense. If you're private, your cost centers to satisfy whatever internal regulations you have, and you still have regulations in terms of the overall regulators, but just not as much, is significantly less. It allows you to run your business and not deal with a lot of, I won't call them distractions, but, you know, other areas of your business that you have to if you choose to go public. My last point. And then you've got the activist board members. Like you see in the news all the time. Like, is that something you really want to sign up for? So as I sit here today, I don't know if we're going to see the same pace of companies going public going forward because of those type of reasons. So that's that.
I guess given that, and perhaps that outlook of public companies, it kind of seems like the only place to go is to look private then, if you have that ability to do so, to find more differentiated returns.
This helps. Yeah, I think the why there's so much interest in the private space now compared to when I started in the early '90s. There's a couple things, right? There's certainly more private companies, right? And so there's more opportunities to invest in those types. I think that's where we should start this part of the conversation: is access has become easier. And when I started, here was the typical private equity strategy I would recommend to a potential client. First off, you were locking up your money for 12, 15 years. Second, you're committing a dollar amount up front, but they would request, we call these capital calls, the money typically over 3 to 5 years with no consistency of when or how. You talked about earlier, you're going to have liquidity buckets or other parts of your portfolio that can fund these capital calls in the future. Back then, super opaque. There's no internet back then, right? Let's acknowledge that. Trust and verify, as I like to say. So that's where we were in the early 90s. You fast forward today, most of the investments that we're talking about for our clients are a 1099 tax offering, so not a K1. You invest your capital. The amount you commit to is the amount that's being invested day one. You typically have monthly entry points. You typically have quarterly redemption opportunities, right? The reporting is much easier. The reporting can sit on most of the custodians. We custody with Schwab and Goldman. I mean, most of the custodians can now report on this, so you can see it in your statements, right? It's just, it's changed so much for the better, in my view. So I think, there's a much easier way to have access to this. I'll give you another example. And I talked about digital assets a little. I mean, 3 or 4 years ago, Ed, you had the big institutions, the BlackRocks and the JP Morgans, pretty much saying, stay away, right? Investors shouldn't be, this is just a passing phase or, too much, and there's still risk and there's still, right, regulations that need to kind of get stronger, but it's just too nutty. Well, this time last year, BlackRock created their own Bitcoin ETF. So I give that example not to say they were wrong, more that there's evolution in this space where you have a lot more institutions acknowledging that investors have interest in this, and if they don't provide it, somebody else will. So I think that's what I'm seeing is there's more of a desire for this, and there's more of an interest in it, and there's more opportunities to access them.
Yeah, absolutely. Just on that Bitcoin front or digital currency front, are you actively incorporating that into client portfolios, or have you modeled that?
Yeah, so we are. So, one of the things we had to solve for is I'm really, it was the custodial aspect or the safety aspect, maybe a better way to say it for your audience. I'm very concerned about the hot wallet situation where somebody could come in the back door and basically steal your coins. No different if, unfortunately, Ed, you've had somebody, access your user ID and PIN to some website, pick whatever it is, and now they're in there and you're like, oh, I got to change everything, right? Well, imagine it's your coins and now it's gone. Good luck trying to get those. So we had to find a cold storage entity that really safeguarded the protection of those kind of keys and those user ID and PINs, which we found. So once you have that, then we got more comfortable with it. And then it's like, what is the right allocation? So, for our firm, anywhere between 2 and 5% of one's total portfolio, we're comfortable owning digital assets, and really Bitcoin and Ethereum are the two that we recommend our clients utilize. So I think it's something that will evolve over time. The regulation environment's gotten stronger. The custodial environment's gotten stronger. The use cases in terms of these have gotten stronger. So there's a lot to like about that space, acknowledging it's still very volatile. So again, it's all in proportion to everything else that you own.
Interesting. So you're managing the digital currencies for your clients directly and sourcing custody and all that directly. Would you ever use now an exchange traded fund for that?
We will. Yeah. It's not my preference, but some clients say, the dollar amount's so small. Like we have a phrase internally, we want to scratch an itch. So sure, if you want to put $10,000 into it, then we're not going to go to the actual coins themselves and set up the architecture and the structure to have that custodian kind of tie into your overall portfolio. We'll just say buy the Bitcoin ETF, and that will satisfy it for now. And if you get comfortable with that, we could talk about a larger allocation going forward.
What's your take on, say, publicly traded alternative asset managers or our publicly traded business development companies, for instance, perhaps as a proxy for the private space or private credit space?
Let me play back that question. So if you're talking about firms that are creating more type of investments, whether it's like a separate managed account or a mutual fund that's trying to mirror some of these private investments,
or like the business development companies, or whether it's like an Ares or a KKR or a Apollo, those as proxies for direct private investment.
I think so. All right, I think I understand. So just investing directly in those companies versus in their strategies themselves.
Yes.
Yes. I like them both. So I do that myself personally, right? And so no doubt, I mean, those firms are really good at what they do. That said, it's a proxy towards the private credit, the private real estate, the private equity, the venture. It's not identical, of course. So when you almost think about tracking error, you're going to have some tracking error there if you're just buying Ares or you're buying Blackstone's equity, and there's nothing wrong with that, by the way, but you're not truly getting exposure to those underlying themes or investments you're trying to participate in. You're like indirectly getting exposure to it.
With regards to I'm going to step back a little bit with regards to the allocation towards privates and whatever investments you make across the different sleeves there. Do you have a benchmark that you look at or an index that you like to reference and go, okay, they didn't do so well this year or over the last 3 years? Is there a target, or is it more of an absolute return target? How do you evaluate the performance and if whether or not you're still happy or not with the investment?
Yeah, you bet. So Ed, the challenge, because some of these investments are opaque, as we've talked a couple of times, is there's not what I would say a go-to benchmark that we would use. There's some general benchmarks that you can use as a starting point. But ultimately, you have to really look at it as an absolute return perspective. What we like to do is when we diligence the manager is say, hypothetical manager X, tell me what your expected return and your expected volatility be for this investment over the next 5 to 10 years. Now, there's no guarantees. We know that we'll guarantee death and taxes, as we like to say. But that's part of our decision to either utilize or not utilize the strategy. Then we'll go back each year and say, well, how did they perform compared to their stated benchmarks? How do they perform compared to the universe? I think the universe is a better way to kind of judge each individual manager. There's plenty of private credit strategies and there's plenty of private equity managers. So we look at it from a universe perspective. And again, the other piece that's really important is it's the risk-adjusted return, right? How much volatility are they going to take for the returns they're expected to generate?
Do you have a preferred source for kind of the competitive universe?
Well, we go back to the iCapitals and the cases. They have some benchmarks that we leverage because they're in this space. Like that's all they do for a living. Is I like to say. I'm sure they do something else, but this is their go-to, right? So we leverage some of their kind of proxies and their benchmarks to help us in terms of identifying if our managers are performing well.
What's one of the biggest lessons you learned that's helped propel your business?
Post-transition, during transition, expand on that, please.
Perhaps post-transition. You've got your new shop up and running, and now where you are today, what do you think has really contributed to your success?
So I'm gonna answer 2 different ways. My first thought was when you were kind of answering the question is I talk to lots of folks who are considering starting their own firm. I get pulled in a good way, right? To talk to people objectively. I would tell them think of it as, when I say it's effectively the wild, wild west, I say it in a good way. You have all these options, but guess what? Now you have to have the resource allocation to implement all these options. So I think one of the things that I knew, but I didn't appreciate enough was you have to staff up or you have to find external third-party resource firms to partner with to build out this infrastructure of the things that you want to do, which are more unique, more complex. Those are fantastic, but just having the mindset that the resources I had previously are not going to be what I need when I start my own business. I think that was an important aha moment pretty early on. And then I think what's really contributed to our success, I'll give you maybe 2 good examples. I think one main reasons I wanted to start this new firm, Ed, was I would meet a lot of prospective relationships. Let's talk about the business owners at the top of the call who hadn't sold their business yet, but they needed advice and counsel pre-liquidity event. Well, in my previous structure, the only way I could work with them was after they sold their business. The money had to be custodied at my previous employer before I can have any document signed to do anything. So it was a assets under management arrangement. And that to me felt really hollow. Or look, we invest capital for our clients every day. It's an important function of what we do for our relationships. But we do a lot of consulting on areas that are not part of their portfolio. And I wanted to be able to separate that out. And if somebody came to me and said, I just need help on the consulting side for 2 years before I sell my business, can you help me? Previously, the answer is no. Now it's absolutely. So part of our significant growth is we're able to say yes to so many more relationships that previously we unfortunately had to say no, not because either side wanted to, only because the employment structure was under. I think that's a big one. And I think the second one would be is I love to tinker. And I love to look at different things and strategies. Now, again, it's incumbent upon us to diligence that next strategy. Whereas in my previous structure, I was at the mercy of whatever the diligence team told us we could or could not recommend to our relationship. So, here's a story that happens a lot. Your neighbor just started a new venture capital firm. You're my client. You come in and say, Craig, I suspect you've never heard of this firm, or maybe you have. Well, you haven't recommended to me previously, so I'm confident that you haven't approved them, but I'm interested in putting some capital with them. Can you diligence them for me? Sure. Previously, I was like, sorry. My firm would say, absolutely not. Well, right. So we just have so many more opportunities to help our clients, and that's really fulfilling to us. And it just provide us significant more relationships to advise.
That's great. That's awesome. Sounds like you're really passionate about what you do, and I love hearing that.
Thank you. Absolutely.
What is one long-term trend you see playing out over the next year or several years? What is kind of like top of mind or seems exciting to you?
I'm going to give you an answer that I'm pretty confident nobody's answered before, but I could be wrong. Here's what I'm diligencing. I believe in the future, Ed, and I think it'll be while I'm still actively leading Reach Your Peak Wealth Advisors. Our families will be looking to firms like us from a health access perspective. So not health providers, that's not the industry we're in, but access to healthcare. So I kind of call the healthcare model broken. I think it's emergency care or sick care, whatever word you want to use. So we build a financial plan for a family, Ed, and one of the largest annualized cost centers in their plan is healthcare, with significantly higher inflation numbers than other cost centers. So it's a big part of their plan. And I'll tell you, even every prospective relationship I talk to comes to me, what are the things that you're concerned about? What are your priorities? Why did so-and-so say it was a good use of our mutual time to be talking today? Healthcare usually comes up in that conversation. We love those conversations because we're tasked to help our relationships. So where I see this going is that more and more relationships, especially in the higher net worth space, when there's an emergency, you could be the healthiest person, and you look pretty healthy, by the way. Congrats. You could be an active runner. You have all the tests. Doesn't mean you can't trip and fall. It doesn't mean you can't hit your head, right? It doesn't mean that you couldn't have a heart attack. Those things happen, right? When clients need streamlined healthcare to the top physician, he or she in their space, they've got the money. That's not the issue. They need the connection to the access points. And I believe more and more our industry is going to be asked or tasked to help those relationships solve for that. There's some firms that are already doing it. Firms meaning they're these health access providers. I use the phrase of Rolodex. They're creating the Rolodex of top professionals that have decided that they can't see 3,000 patients a year. It's statistically almost impossible with any good care, right? The healthcare profession is frustrated too, right? So you have some really fantastic physicians that are leaving the traditional model and looking towards new ways to help less numbers of patients and provide them better care. And I personally think that's where we're heading, and I'm going to lead on that front for our firm to solve for that answer. Remember, I'm an engineer. I like solving problems. So that's the trend I see where we're heading, and I think our industry is going to be part of the solution.
Might have to have you back and talk about just that, because that's been top of mind for me. And I'm sure others in my age demographic too, that have not only kids, but aging parents and then thinking about taking care of them and taking care of myself later on, and then this, I don't know what's going on right now. And maybe it's doctors leaving and becoming more concierge doctors. But it's like almost impossible to get a doctor's appointment for 6 months, where'd they all go?
Can we stand on topic for a second?
Yeah.
Yeah. If time permits. So think of the concierge model. That's an example, but I think it gets more direct. So the concierge model is, as I think we all know, but just to set it, right? So the doctors are saying, I can't see 3,000 patients. I'm going to limit it to 600 patients or 500 patients. And you and I in this hypothetical will pay more for access to a doctor. Excellent. That part I like. It's still though tied to the insurance companies. And I think the insurance companies are the middle person that if it could be eliminated, then you can streamline better care. So I love the concierge model as a starting point. Where I think this is going is taking that model, eliminating the middle person or the middle entity, and having more direct access care to top physicians to, as you correctly said, the reason why you can't get appointments is because the insurance companies are helping these doctors say, you need to see more and more patients every year. And the doctor said, I'm human. There's only so much I can see, right? So I think that's kind of where we're going.
So the way we close out our episodes is with a speed round called Trend or Fad. I'll ask you about 3 or 5 different topics, get your quick take. It's supposed to be fun, no wrong answers.
Okay, got it.
Red light therapy, trend or fad?
I'm not even familiar with red light therapy, so I'm going to pass on that one.
The raw milk trend or fad?
I must be really boring. I'm not familiar with that one either.
I wasn't either. I asked you about this kind of at the top, but private equity secondaries.
Oh, that's a trend. I mean, we could spend a minute on that. So private equity secondaries are ones, so you want to talk about a subset of a subset. So private equity secondaries, we are very bullish or passionate about, whatever phrase you want to use. It just a level set for your audience who may not understand the secondary environment, right? So typically, secondaries are the opportunity to buy a private equity company, in essence, at a discount. And you're buying it at a discount because the previous company or originator or even a manager that helped fund this startup is exiting out of the space or has been tasked to do things differently, or unfortunately, they may have their own distress and they have to basically sell off assets. There's a catalyst for the secondary. And so the big picture is you're able to buy, once you've done your diligence, of course, a really good company at maybe 80 cents on the dollar, 75 cents on the dollar. And so, the industry calls it the J curve. We could spend time on that today or in the future. But in essence, you're buying a company early on in the stages at a discount. Most startup companies, Ed, I suspect, I'm confident you know this, but maybe for your audience's education, most startup companies in the first couple of years aren't turning profits, they're turning losses. It's capital intensive to build up the infrastructure, to build up the technology, to build up the resources. And then, oh, by the way, you got to go find clients, right? And you have to advertise, you have to market. So to that point, that J curve, the first couple of years, you're losing money. The really good firms hit that turning point or that tipping point, whatever it is, and then they start to accelerate and take off like a rocket ship. And so private equity secondaries are fantastic. Again, diligence isn't critical, but we use private equity secondary managers within our portfolio construct.
Well, Craig, thank you very much. This has been fantastic. I really appreciate your time and your insights. What are the best ways for people to learn more about you and what you're doing and follow Regent Park?
Oh, thank you.
Regent Peak, sorry.
That's okay. Yep. So I think obviously our website, regentpeakwealth.com, will be the easiest and fastest way for individuals to learn about our firm, learn about our talented professionals, learn about the families that we serve. There's lots of video content. There's podcast copies. There's periodicals. There's white papers we've written. But I think that would be the easiest way for an individual to learn more about our firm and, again, the relationships with the families that we serve.
Fantastic. Craig Robson, thank you very much for your time and being on the show.
Thank you, Ed. Appreciate it.
Thank you for tuning in to another episode of Trends with Benefits.